Started again. Good morning and welcome to this Wednesday, December 8th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We got off to a pretty decent start this week, especially yesterday. Had a big day. We'll go through that in just a minute. Futures this morning looking like we're going to continue that move to the upside, although it is just fractionally higher. So we'll take a look at that in just a minute. For those of you that are new, I'm going to go ahead and take you over to Earnings Beats just to point out a couple of things. Number one, anybody who would like to try our service, we'd love to have you. We do have a 30-day free trial. So you can click on this, get your 30-day free trial started. That does require a credit card, so we can get you set up in our system. But we'll let you know at the end of your 30 days before we charge you, give you different options for annual membership and things like that. So if you want to try us out for 30 days at no cost, please do. If you're just learning about Earnings Beats and you really want to just find out a little bit more about who we are and what we do, I'd say probably the best way to get started is not only listen to the show and follow my blogs over at Stock Charts and so forth. We also have this free Earnings Beats Digest newsletter, which comes out every Monday, Wednesday, and Friday, so 3 times a week. All it requires your name and email address, no credit card. You can unsubscribe at any time, but just type in your name, email address there, hit that subscribe button, get started. I talk a lot about earnings, relative strength, gaps, candlesticks, things like that. So if you are interested, and it's a very short read, by the way, normally just a couple quick paragraphs and a chart. So normally maybe it's something that'll take you 2 minutes in the morning to take a quick look at. Anyhow, I want to make sure everybody's aware of that. Moving on to the market on Tuesday, it was a big day. The Dow Jones Industrial Average up almost 500 points. The S&P 500 up 95 points, getting back close to that 4,700 level, so not far from setting a new all-time high. The Nasdaq was the best of the bunch, though, on a percentage basis, up more than 3%, 461 points. Back up to 15,686. I'll talk about this one in just a minute. Could be a little pattern there we want to kind of keep our eye out for. Mid caps up 1 2/3%. Small caps just a little less than 1.5%. So across the board, very strong action. And the thing that I noticed more than anything else was we're back above the key moving averages on all of our major indices. So if you thought this was a downtrend, normally you don't go back through the moving averages. I'm not saying it can't happen or won't happen, but normally if you're starting to trend lower, when you come up and you hit those moving averages, you fail and you go back down. In this case, we moved back up. So we haven't broken out just yet on our major indices, so I'm not ready to claim victory there. But once you get back up above the moving averages, it starts looking more like sideways consolidation rather than a downtrend. So I like the fact that we got back up to the moving averages. I think that gives us a lot of hope here in the short term for a continuing recovery, or at least an extended period of consolidation before another breakout. That's really what the market's telling me right now. Looking at the sectors, technology, as I mentioned, we closed at 172.52. While we didn't take out the intraday high from a couple of weeks ago, we did actually close at a new all-time high yesterday on Tuesday. So technology, very strong day, up about 3.5%. That certainly was the big factor, the driving force behind the Nasdaq's 3% gain. Energy gained another 2 1/3%. So it too is back above its key moving average, along with discretionary stocks, which gained 2 1/3% as well, moving up above their 20-day moving average, which is above the 50. So configuration there remains strong. Financials up about 1.8% yesterday, getting through the 20-day, but not quite getting through the 50-day. So we still have a little work there. And then finally, real estate breaking out to a new all-time high, moving up about 1.7, well, 1.75%, but closing at a new high, breaking out above that late November high. So all in all, action yesterday, very strong. All 11 sectors were higher. And it's been crazy here, I would say, over the last 2 weeks, 2 to 3 weeks. I can't remember exactly how many days we have seen either all 11 sectors higher or all 11 sectors lower. I mean, it's got to be probably at least 5 times now in the last 2 weeks that we've had these great days or horrible days. But it all appears to be part of consolidation. sideways consolidation, which is good news. All right, moving on. How about the 10-year Treasury yield? Let's get a quick update, see where we are here on this. Right about 1.5%. We're continuing to move higher off of that low that we saw last week. Went down to 1.34%, which pierced that 1.3% or 1.37% level that I was watching for support. But literally, it was just that one day and then right back up again. So we do have a new support level to watch at 1.34. Big question, can we get back through this 20-day EMA? If you noticed when we downtrended last time, we, for the most part, kept failing at the 20-day, trending lower. When we were trending higher, we were mostly above that 20-day. So are we trending or are we simply sideways consolidating? Because when you sideways consolidate, you go up and down, above and below these moving averages. My guess is we're going to consolidate. If the S&P 500 looks like it's going to consolidate, I would suspect the 10-year Treasury yield is going to do the same. Probably the biggest factor as far as which way the 10-year Treasury yield goes here in the near term is going to be Friday morning. Friday morning, we're getting the consumer price index, the latest inflationary reading at the consumer level. And I think that's got the biggest chance of driving interest rates one way or another. If that number comes out really hot, hotter than expected, and keeps all those inflation fires burning, then I would expect 10-year Treasury yield to move right up through these moving averages. That also could be a problem for growth stocks if that were to happen. On the flip side, if the inflation number is more contained or even lower than expected, then we could see more of this sideways consolidation, maybe lower in the 10-year Treasury yield. And you would think that would bode well for the growth stocks. So we'll see. Growth stocks were not doing well, though, recently when the yields were falling, which was very unusual. And now they've been bouncing back with yields moving higher. So whole market has been kind of crazy here the last couple of weeks, but I just think there's a lot of consolidation going on at this point. I think until we get the big breakouts one way or the other, and then we'll see if we do get a breakout to the upside, we'll see what's leading the market. That's going to give us a lot more clues as to whether or not the rally, potential rally, is sustainable. Let's move on to talking technically. I wanted to go through a couple of charts with you. Number one, this is the consumer discretionary group relative to the S&P 500. Now, the last 6 weeks been pretty choppy, as you can see, moving up, topping, moving all the way back down to hit the 20-day, moving back up, testing the top, moving back down a little below the 20-day, starting to hook back up. I'd really like to see this move back through the 20-day. So this will be one chart I'll be watching, not only today, but over the next several days, just to see if we can get back through or not. What we don't want to see is a temporary, move back below, a temporary move above, and then another big down move. So that'll be something to keep in mind. Watch maybe to the downside, the recent low, and then also that 50-day moving average. Let's watch that in terms of relative performance on the XLY. The other one I wanted to show you, though, is the XLK. And the XLK, we just saw the breakout on an absolute basis. On a relative basis, we're moving back up and staying above this rising 20-day. Once you move above the 20-day, as long as you stay above that 20-day, it's hard to bet against technology. Again, this is not the absolute chart. This is the relative chart. So this is just telling us that as well as the S&P 500 has done, the technology group has done that much better. And in November, when we've seen a lot of this weakness, technology has held up well. Now, it's not all of technology. You got to realize that you got Apple. Look at what Apple's doing. Apple's the largest component in that technology ETF. It's largest in the S&P as well, but it's much larger in the XLK in terms of percent. So when you see Apple doing this, chances are you're going to see technology performing well versus the S&P 500. So I'd say a lot of this is Apple, but not all of it. We'd have to go through and pick apart all the components. But Apple itself, Apple's a big company. Apple can do a lot to move the lines on the chart, but Apple's not doing everything. So we do still have some strength there. I know semiconductors really bounced back and have performed very well. Can pull that chart up for you real quick. Here you can see breaking out yesterday to a new all-time high. So again, it's not just Apple. You got semiconductors moving up to an all-time high. All right, what else do we have for you today? Well, how about the VIX? Remember how the VIX was went up to mid 30s recently? Remember we talked about 30 to 40 in the VIX has a history of marking bottoms in secular bull markets. Well, it did it again. There we are up into the 30s. You know, I always talk about, when you're trying to find a bottom in the stock market during periods of weakness, I try not to look at the technicals. I look at the sentiment, because you can go right through moving averages. You can go right through support levels. It's really about getting the fear up to a level where it seems like the kitchen sink's being thrown in. And once that kitchen sink gets thrown in, that's normally when the market bottoms. So the VIX gets up mid 30s and then comes back down. And when you look at the S&P 500, we come down, we mark that bottom at 4,500, and we're right back up again. Now, one thing I also wanted to show you, because I have had questions about this, how I set up my VIX chart versus the S&P 500. So here's the chart. So it's just a little stock charts tip. Now with the VIX, first of all, the candlesticks, they are just kind of, it's just noise to me. I mean, I like to see the variation, the volatility. But when you're looking at a 5-day simple moving average, what I normally do is I'll go down here first and I'll put in invisible chart. Right now it's on candlesticks. By putting in invisible and hitting update, all you're going to see is the moving averages, the overlays. All the data behind it goes away. Now, personally for me, I don't want a 50-day moving average or even a 20-day moving average of the VIX. I just want a 5-day. I want to know, 50-day, by the time the volatility goes up and down, the 50-day is just going to move too slow. I want to see, something that's pretty quick. We could leave it at 1 day, but a 5-day moving average, I think, is pretty good. And then the other thing I do is I do a correlation with the S&P 500. So over 20 days or over 20 periods, in this case, it's 20 days since it's a daily chart. But I look at the correlation between the S&P 500 and the volatility index. And if you follow the VIX, you know that when the S&P goes up, the VIX goes down. When the S&P goes down, the VIX goes up. So what you would expect on the correlation before we even pull it up is you would expect to see mostly inverse correlation between these two. So let's take a look first and let's just go down. And there's your inverse correlation. We're down to -1 almost all the time, or certainly between 0.75 negative down to a -1.0. That's where this correlation lives mostly. But you see these different pops here. And this is where it becomes interesting, because if we pull up the S&P 500 itself, what you're going to see, and I'm going to take this chart back at least 2 years. Let's go back 2 years. You don't see these spikes very often, but every once in a while, you see this correlation spike and go positive. Now, normally, the VIX and the S&P are inversely correlated. So this move tells us that while the stock market is moving up, fear is also building. Volatility is going up at the same time. So here, as you can see, the S&P 500 at the end of August 2020, see the rise in the S&P? And look at the VIX starting to turn higher. This is a 5-day moving average, which is going to take a little while for it to get going. By middle of August, it had bottomed and started trending higher. So what that did is it sent this correlation, because they were now moving together, it sent the correlation back up above 0. And that positive correlation tells us that the market's getting more nervous. And so what I always say is that, while the market's going up and it may continue to go up, if we get bad news, it may not work out well for the market, because the market's already beginning to get a little bit more fearful. It's kind of like the anxiety, like if you're going to a dentist office or a doctor's office or going to get a needle, and sometimes the anxiety just wears you out before you ever even get the needle. And that's kind of the way the market is. It's like the market's starting to get worn out before it ever even sees the bad news. Then when the bad news comes, it just panics. And so here back in September, we topped with this at plus 0.75, which was the highest reading that we've ever seen in terms of the correlation. So, and then we went down for a couple of months. Now, did that start a major bear market? No. It just told us the market had gone too far, was nervous about things. And then we started, any bad news at all, and we're going to struggle for a while. So we saw that, did basically the same thing. Here, back in May, we made this move. You can see December didn't really do a whole lot. We went a little bit positive, and we went sideways maybe for 2 weeks before breaking back out. Here, we did pull back temporarily. Looks like maybe a 3% pullback, something like that. And then this time we got probably about maybe 5% pullback. So these are just warning signs that from a long-term perspective, if you're a buy and holder, ignore it. This has nothing to do with the long-term stock market. In the short term, if you're a trader, I think this can be really important, because if you recall, 2 weeks ago, I was saying, just be a little bit more cautious, whether that's building cash, whether it's selling part of your positions, whether it's selling calls against your positions, maybe buying put insurance. That's, just doing something maybe to help protect your portfolio. Again, we could have gone higher. We didn't have to pull back, but we, could see that the clouds were building. And I think when it's, it's kind of like outside, you see the clouds getting darker and darker, and they're moving closer and closer to you. And you're going to be outside for the next 15 minutes. It might be smart to take an umbrella with you. You might not get any rain, but it's still going to be smart to take that umbrella. That's the same kind of concept here when you start to see the volatility index rising with the S&P 500. Look at where we are now, though. Now everything's back to normal again. VIX is not a problem. So just something to keep in mind there. All right, one more thing before I'm going to show you a scanning technique that you might use. Let me, this is something I put in our members' daily market report yesterday. I sent out to our members. Was it here? Which one was it? Yeah, actually, I think this was the one. Let me go ahead and annotate this. Because what I'm, maybe seeing at this point is like an inverse head and shoulder. I'm not saying this is what's going to develop. One thing I like to do when I believe we're in a secular bull market. So some people, when things start going bad, I look at my indicators. If my indicators are still saying, hey, we're in a bull market, I don't look for bearish patterns. I don't grow bearish. I grow cautious in the short term, but I don't become a bear. Instead, what I do is I begin to look for bullish continuation patterns. A continuation pattern is a period of consolidation that follows a prior uptrend. So here you've got the Nasdaq moving higher. We top, we go through this period of selling. Hey, we're not going to go up every day. It'd be awesome if we did. I mean, we could all retire in about 3 years. But that's not the way the market works. The market goes up, it goes down, it frustrates people. Folks think it's rigged, everything else, and to some degree, maybe it is a little bit. But these periods of consolidation, I think it's very helpful to recognize not only the patterns that form, but also patterns that could form. So, I mean, off of this uptrend, we could just go straight up here to the top and get a cup. We could, maybe work on a cup. But one thing, when you get an A, B, C correction, that's also the start of an inverse head and shoulders. A is the shoulder, B is the left side of the neckline, C is the head. So potentially what we could do is come up here and test this reaction high, this B. And if we do that, that would be perhaps the right side of the neckline of an inverse head and shoulder continuation pattern. Now, what I like to see is a slightly higher, I like to see an upsloping neckline. So it just shows that we've got enough strength to take out these prior highs, even if it's just temporarily, and then come back down one more time to this low, or maybe a little bit above this low. So we kind of have this upsloping head, inverse head and shoulder. And then when you break out, not only, and I see sometimes these point down like this, like if we were to pull back from here, some might say, well, there's your neckline. If we break out above right here, then we've broken out. Well, the problem with that is we still haven't broken out above this prior high. So we still have price resistance. So breaking out above this neckline still doesn't necessarily mean we're going to clear this price resistance. So I always like to have this equal or higher, preferably just a little higher. So, and again, we might go straight up to the 16.2 level. But if we don't, and we go up and we hit this level, this neckline resistance, and pull back one more time, it could be a news story. It could be the Friday inflation. Could be CPI on Friday that does it. Who knows what does it? But my whole point here is just don't give up on the market if we do get another pullback here. All right. All right, next up, I wanted to look at technology. So, and develop a scan and just show you one thing that, you can do sometimes. If, you see technology breakout and you're like, wow, I know Apple's doing well, but I wonder what other technology stocks are doing well. If you go back and you count the days, it was 11 days ago that we set the all-time high close. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, if you count the candlesticks. And the reason that's important is when you set up a scan, you can tell the scan engine to look now versus 11 days ago. The scan engine doesn't care about weekends. So it only cares about market days, not calendar days. So when you look back and you say, okay, the technology group's now breaking out above where it was 11 days ago, you can actually run a scan against technology looking for stocks that have strong rate of change over the last 11 days. And this is how you would do it. So here I just have stock, type equals stock, daily simple moving average of volume, the average volume over 50 days, at least 200,000. You can change that. You could make it 100,000. You could make it 500,000, whatever you want to do. Or you could do it 20,000. I mean, I like to have stocks that are liquid. I normally don't look for stocks that have average volume under 200, certainly not under 100,000. All right, then I went in. Now the default, when you put this in, the rate of change is found under the technical indicators. So all I did is I went down here and I grabbed rate of change and I hit add. And so when you see it down here, see how it comes up with 12? That's the default. 12-day rate of change is greater than 0. I changed it to 11 days greater than 5%. All right, so I'll get rid of that rate of change. Next group is technology. All I did is went down here to sectors and scrolled down, hit technology, add. All right, so there's that. And then the last thing I did was on the scooter, under price, volume, and scooters right here, add scooter. And it comes up 90. I just changed it to 70. And so this is where I am. Now, you could change the rate of change. You might want to see stocks that have gone up 10%, have been really strong. Maybe because the technology has only gone up maybe 0.5%. Maybe you'd lower this to 2 or 2.5%. Get more stocks. Completely up to you. You could change the scooter. Now, when I've run the scan, I get 30 stocks. So now I have 30 stocks in the technology area that met all of these requirements. Scooters greater than 70, obviously they're tech stock. The rate of change over the last 11 days has been more than 5%. So they are in effect, these are the stocks that are driving technology right now in the short term to a new high. Doesn't mean they'll continue to, but the combination of the big move and the scooters being above 70, these are probably a group of stocks that I'd be interested in. So now what I can do is I can drop them, replace an existing chart list. So I usually just go try to find one of my scan results, and I'll just put it in other. And now I've got these 30 stocks in a chart list. Now what do I want to do? Well, I mean, I probably would put in the sector and industry group and the scooter so I can see all of that. So now I have all of that. And I might want to sort it in scooter order and just see, what's going on. I might also want to see, okay, how have they done over the last week? And let's sort it based on, there's your scooter. And you can see Marvell Technology, 28%, Ambarella, 20%, Silicon Motion, 27%, Tesco, 27%. Here's Kulik and Sofa, 12, almost 13%. Here's Apple, by the way. Apple, 3.56%. So, technology's only gone up, maybe 0.5% over where it was 2 weeks ago, 11 days ago. But Apple in the last week is up 3.5%. Now, it's not up 20%, but that's a big market cap company. So it's obviously doing its share to pull the company. But then you can go through and you'll find some companies that I think, I wrote about Pure Storage a while back. I don't know, maybe a week, 2 weeks ago. I think it was on this earnings right here. I loved this earnings report. Big volume, gapped up above these prior highs, and then finished strong and has continued moving higher. So this is a stock that's a leader right now. If you want to see what the leaders look like, pull it up on a relative chart. Here's your computer hardware group. Here's PSTG relative to computer hardware. It just with its earnings just set, it looks like maybe a 9-month relative high, crushing the S&P 500. And now you got computer hardware on fire. So here's one of your leaders, PSTG, any kind of a pullback, I'd be interested there. All right, let's keep moving on. Let's go to earnings. Here was a stock. This is a stock that I actually put out this morning in the EB Digest, Thor Industries. And I said, I thought it would probably go lower. Wall Street's not a fan. You can see relative strength versus its peers is near a 52-week low. Overall, the group hasn't been very strong, had a little bit of strength beginning in November, but starting to roll back over again. So what I said is I just don't want to deal with a stock like this. I feel like the risk is to the downside. Not that I would be shorting it. I just probably wouldn't be doing anything into earnings. But the stock actually beat top and bottom line. I saw that this morning. And you can see it's up 2% to 108.62. Now, going back to the chart, 108.62 is not even above the high from yesterday. So I don't know that that's necessarily going to get me all excited. I think this thing needs to start breaking out maybe to multi-month highs, which it's got a long way to go to the upside to do that. I'd be more worried about a potential breakdown because it is a stock that's been underperforming its peers, the S&P 500, and it's not in a great group. Combine it with the AD line, which is sitting at a 52-week high, I'd be worried about a gap up, to be honest. With that AD line, that's telling us the stock tends to close more toward the low of the day than the high. So gap ups would be something I would have no interest in chasing. Now, this one didn't work holding into earnings. Let me show you a few that did. And we'll go ahead and just use this as the 3 you must see to wrap up. So you want to see what 3 stocks that were performing poorly going into earnings look like after earnings? Here's AeroVironment, defense stock, 52-week low relative to the defense group prior to its earnings coming out. And defense was down near its 52-week low relative to the S&P. Stock comes out with earnings, look what happens, gets crushed. How about DocuSign? I mean, DocuSign came out recently with this big gap down. Were there warning signs? I think so. Look at where DocuSign was relative to the software group, downtrending for 5 months prior to the earnings coming out, which were absolutely horrible to the downside. So you've got another one. That's 2. I thought I had one other one. Actually, I was going to use THO. I'll tell you what, there was a company that came out. We'll take a look at this one because they came out yesterday after the close. Stock is down 26% this morning. Stitch Fix. So here's Stitch Fix trending lower. AD line near 52-week low. Look at the relative strength of Stitch Fix versus its peers. Look at its peers. Not a great group. Closer to its 52-week low than its 52-week high relative to the S&P 500. And this is what, Stitch Fix did. Okay, the market just opened. Let me give you an update on Stitch Fix and show you. Oh, actually, it was already there. So right here, you can see it down 27%. These are the kinds of stocks I would want nothing to do. Okay, Thor, I missed it, went up 2%. I don't even know, maybe it's coming back down after earnings. Maybe it's shooting higher. Oh, there you go. It's already gone red again. So these are the types of stocks. I mean, I've used these over the years as just learning moments and trust me, I had my fair share of tuition I had to pay on some of these holding into earnings before I started to realize what was going on. And most of my big losses with earnings came with companies either that had gone straight up and had great numbers and just sold off anyway, buy on rumor, sell on news, or on stocks that I felt like, okay, they've been sideways consolidating. And therefore, maybe we'll get that pop with earnings. Well, they didn't, because the market was going higher. So while it was sideways consolidating, its relative strength was dropping. And these are the stocks. I just think any stock holding into earnings, you've got to be willing to take on extraordinary risk. All right, let's go ahead and wrap up. Final chart, just look at our final review here of the market. Dow up 25, S&P down 2, Nasdaq down 49. So now we got a little bit going the other way. Growth was leading yesterday. Looks like maybe it's down a little bit today. Small caps, mid caps, both fractionally higher. Volatility index, though, pretty flat, sitting down around 21, a far cry from 35, where it was just a couple of days ago. All right, that's it for me. I'll be back tomorrow over at Stock Charts TV. You can access the show at 9 a.m. Eastern simply by clicking on the Stock Charts TV link right here. That'll take you into the show. Hopefully see you there tomorrow. Everybody have a great day. Happy trading.